As part of your financial aid package, you may have received subsidized and unsubsidized loans. But what is the difference? Which ones are better? What should you know about each? We're going to talk about all of that in this video. The main difference between subsidized and unsubsidized loans is that with subsidized loans, the U.S. Department of Education pays or subsidizes the interest rate while the student is enrolled at least half-time in college, during deferment, and the 6-month grace period after graduation. On the other hand, the interest on unsubsidized loans begins accruing from the moment the loan is disbursed to school. Subsidized and unsubsidized loans share more similarities than differences. They have common requirements such as being enrolled as a half-time student, holding a high school diploma, and being a U.S. citizen or permanent resident. Surprisingly, you have to have and maintain a minimum GPA of 2.0. Both loans types are available for students attending four-year colleges, universities, community colleges, as well as trade, career, and technical schools. Another advantage of these federal student loans is that there is no credit check or need for a co-signer. The student can secure these loans in their own name without mom and dad co-signing. However, if you defaulted on previous federal student loans, you'll be disqualified to receive new ones. Who is the lender on these loans? The lender on these loans is the U.S. Department of Education. And both subsidized and unsubsidized loans are issued in the name of the student, not the parent. Only undergraduate students can receive subsidized loans. However, unsubsidized loans can be received by undergrad, graduate, and professional degree students. Another notable difference is that subsidized loans are granted based on financial need. Only students who demonstrate financial need are eligible to receive subsidized loans. In contrast, unsubsidized loans are available to any students regardless of financial need or the ability to cover education expenses. Another interesting requirement for first-time borrowers is the maximum eligibility period for subsidized loans, which is typically 150% of the published length of the borrower's education program. For example, if a student is enrolled in a 4-year degree program, the maximum eligibility period for subsidized loans would be 6 years, and a 2-year degree student can receive subsidized loans for up to 3 years. On the other hand, there is no time limit on using and qualifying for the unsubsidized loans. The interest rate on both subsidized and unsubsidized loans are fixed and remain the same throughout the loan term. As of July 1st, 2022 until July 1st, 2023, the interest rate for undergraduate students is 4.99% for either loan time. However, if you're a graduate or professional student, you are only eligible for unsubsidized loans, which carry a 6.54% interest rate. Another important factor is that direct federal loans operate on daily interest system, meaning that interest accumulates on daily basis rather than monthly or annual, which is usually the case with other form of debt such as credit cards or mortgages. Let's go through an example. Let's say we have a $10,000 direct unsubsidized loan with a 4.99% interest rate, which is current rate. To calculate the daily interest rate, you divide the annual interest rate of 4.99% by 365 days, resulting in a daily rate. Then you take that daily rate and multiply it by the loan amount of $10,000, which gives you a daily interest amount of $1.37. And over a 30-month period, the total interest would amount to $41 and $499 in a year. Who pays the interest? We have already talked about this, but let me reiterate the primary advantage of subsidized loans. The U.S. Department of Education pays the interest rates on these loans while the student is attending school and for an additional 6 months after graduation, known as the grace period. However, once the grace period ends and the student begins repaying the loan, they become responsible for both the principal and interest. On the other hand, unsubsidized loans require the students to bear the burden of interest charges from the moment the funds are given to the school. Additional benefit is that if the student chooses to go to graduate school immediately after their undergrad studies, there will be no interest accrued for up to 10 years. Unfortunately, that is not the case with the unsubsidized loans. If you borrow $5,000 in both subsidized and unsubsidized loans with an interest rate of 4.99%, the subsidized loan would accrue no interest during the 4-year period. However, the unsubsidized loan would accumulate approximately almost $1,000 in interest over that time. As a result, if you pay $100 a month, it will take you additional 10 months to pay the unsubsidized loan. If you have unsubsidized loans, you have two options. Firstly, you can opt to pay the interest on your loans while you are in school over the 4-year period. Or instead, you can choose to let the interest accrue, meaning it's going to be added to the principal amount of your loan. However, under the second option, which is known as capitalization or accumulation, the interest will increase the overall repayment amount. And furthermore, you are basically paying interest on top of interest. It's not the U.S. Department of Education that sets the interest rates on federal student loans. The responsibility lies with Congress. And annually, during the spring, Congress establishes the interest rates for federal student loans. These updated rates apply to student loan dispersed between new academic years starting in July 1st of the current year until the June 30th of next year. Beginning with 2013-2014 academic year, both subsidized and unsubsidized undergraduate loans have carried the same interest rate. Prior to that, there were different interest rates for subsidized and unsubsidized for undergraduate students. Currently, there's still a different interest rate for unsubsidized loans for graduate students. Repayment for both subsidized and unsubsidized loans starts 6 months after graduation, provided you are at least half-time student. While many students by default are enrolled in a 10-year repayment plan, you have an option to change to different repayment plans such as income-driven, graduate, etc. If you encounter medical, economic, or other hardships, you have the option to request student loan deferment. And if you do qualify, during the deferment period, the U.S. Department of Education will cover the interest charges on the subsidized loans. However, for unsubsidized loans, although your payment is paused, the interest rate will continue to accrue on the loan. In addition to being charged interest rates, borrowers are also required to pay loan origination fees, which currently amount to 1.057% of the total loan amount. These fees are calculated as a percentage of the loan amount and are included as part of the principal loan balance, which means that these fees are deducted from each loan disbursement. For example, on a $5,500 loan, the fee would be $58 and the amount disbursed to the school would be $5,442. So how are the loans dispersed to the school? First, you need to complete FAFSA to determine if you qualify for federal student loans. Then you have to accept them with the student login, as these loans will be in the student name, not parent. Next, you will need to complete entrance counseling, which basically ensures that you fully comprehend the terms and conditions of your loan, learn what the loan entails, how interest works, available repayment option, and how to avoid delinquency and default. After completing the entrance counseling, you will be required to sign the Master Promissory Note. It is a legally binding document in which you make promise to repay these loans, including any accrued interest and fees. Only after completing all these steps, the funds will be dispersed directly to your school. Schools follow a specific order when applying dispersed loan funds to the cost of attendance. The funds are first applied towards tuition and fees. If the student will be living on campus, then room and board expenses are covered. And only if there's any money left, the school will return the excess funds to the student. How much can you borrow? The amount of money you can borrow is determined by the school and cannot exceed your financial needs. And how is the need determined? The student's financial need is determined by calculating the difference between the cost of attendance, which includes expenses such as tuition fees, room, board, books, supplies, etc., and the expected family contribution. The expected family contribution is calculated by filling out FAFSA and is based on the student and family financial resources and ability to contribute to their education. Finally, any grants or scholarships that the student receives are subtracted from the cost of attendance as they are covered. You can't simply borrow however you want or to cover the entire cost of attendance. It's actually limited by some maximum amounts that you can borrow in federal student loans. Additionally, it depends whether you are considered dependent or independent student. Students are classified as dependent when they are claimed as dependents on their parents' tax return, which is the case for majority of undergraduate students. In such situation, the parents' financial information is necessary to qualify for the federal student loans. The loans for dependent students generally have lower loan limit. On the other hand, independent students include a graduate, professional, and select undergraduate student who are not claimed as dependents on someone else's tax return. They are not required to provide their parents' financial information when they apply for federal students loans. Additionally, students that are married, serve on active duty, or have and support dependents are also considered independent. These loans for the independent students have much higher loan limits. For first-year dependent undergraduate students, the annual loan limit is $5,500, of which maximum of $3,500 can be in subsidized loans. Then each year, the maximum amount increases by $1,000 with an aggregate limit of $31,000, of which $23,000 can be subsidized. Let's take an example involving two first-year undergraduate students, Jane and James, who attend the same school. Both students have a cost of attendance $32,000 and receive $8,000 in scholarship. The key difference lies in their expected family contribution. Jane's EFC is $12,000, indicating a financial need of $12,000. As a result, she qualifies for a maximum of $3,500 in subsidized loans and $2,000 in unsubsidized loans. On the other hand, James has an EFC of $27,000, which means he does not demonstrate financial need. James can still receive the maximum of $5,500 in federal student loans, but they can only be unsubsidized. Independent students have significantly higher loan limits. For first-year undergraduate independent students, the maximum total federal loan amount is $9,500, so higher from the $5,500 for dependent students, which includes a maximum of $3,500 in subsidized loans. However, independent graduate or professional students are not eligible for subsidized loans. Instead, they can only receive unsubsidized loans, but the maximum is $20,500. What is advantageous about federal student loan is that you can cancel them. Prior to the loan being dispersed, you have the option to cancel either subsidized or unsubsidized loans, either partially or in full. If the loan has already been dispersed to the school, you have to return the funds, obviously, but if you cancel within 120 days of the disbursement date, you will not be charged any interest or fees on the canceled portion. 529 plans are intended to pay for education-related expenses like tuition, but you could not use them to pay off student loans. However, under the Secure Act of 2019, now you can use the 529 funds to pay off up to $10,000 of student loans per beneficiary over their lifetime. So for example, if you have two children, you can use maximum of $10,000 from the plan to pay off loans for each child. Good luck in your education endeavors and thanks so much for watching.